Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Scouten. Jumping into the charts on this September 19th. So overall, the S&P managed to recover and turn positive. You can see that this was our gap down this morning. And it looked like we were going to be taking out the lows, but we managed to hold this little triple intraday bottom over here. So nonetheless, weakness in the morning, market sold off. And then markets had a beautiful rally, check back to support, and then they started grinding up on the light volume. The volume today was below average. On the S&P 500, daily volume count was around 56.25 million, and the 25-day moving average is 74 million. So clearly lighter volume today. This is probably coming on the back that most of the moves have already been priced in just due to the fact that we do have lots of economic data coming out this week, as well as very, very important Federal Reserve interest rate decision, and obviously the the long-awaited J-Powell speech. And then also on Wednesday, before the Federal Reserve statements and rate hikes, we actually get to hear from the ECB, the European Central Bank. So that's going to be critical as well. Will they start to be leaking a little bit of information based off of how aggressive they're being? We can maybe kind of expect, if the ECB is aggressive, we may also expect the Fed to be aggressive and continue to be hawkish. So nonetheless, the beautiful thing about this level is if we flip to the daily chart, you can see that we filled this beautiful technical daily gap over here. That's a thing of beauty. As a technician, now that is satisfied. That gap is completely filled as resistance. And the fact that you're closing up near the highs into resistance is short-term bullish. Now, what I am going to caution investors and traders that we have now triggered a head and shoulders on the S&P 500. So, with a head and shoulders pattern, here you have your left shoulder, here you have your head, and here you have your right shoulder. And you've triggered the neckline, which is over here, major pivot to major pivot, and this is triggered now to the downside. A downside action on this move takes you roughly to the, let me just pull up my calculation, but the downside action will take you roughly somewhere down to this 3,500 and change level. So clearly a big drop on the S&P 500, which could be happening over the coming weeks, and that's certainly going to put a lot of pressure on these markets if the S&P begins to fall. Leave the overall indices very, very vulnerable in the near term to substantially more downside. And the interesting thing to note is that this technical bearish pattern should coincide, it's obviously coinciding with the fact that QT, quantitative tightening, is started to ramp up in full effect in September, actually at the beginning of the month. Now, what is likely that we can see is we could potentially see a push tomorrow up into this retrace of the neckline. Now, for the bearish people out there, a retrace to the neckline would be your opportunity to start shorting the indices as soon as we hit that level. Now, the one thing that we have to be cautioned with and really pay attention to is that if you recapture and close above this yellow trend line, this neckline, then that head and shoulders formation is negated, and it's likely that we could have a massive rally all the way up to this gap fill. Often the biggest move comes from failed patterns, so if this bearish pattern fails, we could start to see the bulls grab a hold of this market and push it up. Now, I'm in the camp that we still see more downside. Therefore, I think the retrace to the neckline happens before the rollover starts to occur. Now, to the downside, we still have this technical gap over here. This one's very, very minor since we've pretty much bounced right above it. This one's going to be a little bit stronger, but again, maybe you get an intraday or a one-day bounce. And then these lower gaps down over here around the 36.77 and your double bottom, of course, is going to be your major gap where you might see maybe a few days of some sort of a bounce. So if we take a look at the US dollar and why the markets rallied, intraday action pretty much sums it up. This is when the markets were selling off, the gap down occurred, markets almost made a new low, and then the US dollar ran into some key resistance, and you can see it sold off, tried recapturing, failed to recapture that high, made a new lower low, and then slowly started to trend lower. And that's what gave the market its true breadth and momentum, along with the light volume. But if you look at the daily chart, nothing has really changed in my opinion for this dollar. Yet again, another consolidation. We did say that it's most likely the move, either the breakout or the breakdown, is going to occur with the Fed. And I still think, just due to the fact that this is an extremely tight bull flag that is occurring, and the fact that you've tested this once, tested this twice, I think now in the third attempt you're actually going to continue to break out. At the minimum, test this double top, but I think we're getting a pierce of that double top, and we'll just have to reassess the pattern at that point in time. But I'm still bullish on the US dollar. I don't think there's much that can stop it at this point in time, unless the Federal Reserve starts to wane on their interest rate and economic tightening. If we take a look at the US 2-year yield, so if we take a look at the US 2-year yield, so it's pretty amazing considering we were watching this breakout over here 1, 2, 3, 4, 5 days ago, and now you've had a tremendous move up in yields in the US 2-year again. This is showing that the the federal fund rate is anticipated by the bond market to get to 3.94%. So that's a substantial increase that the Fed still have to continue to raise, which is why the markets have been under a tremendous amount of pressure. But the fact that you have 1, 2, 3, 4, 5, 6, 7, 8, you would expect one of two things to happen: a sharp pullback in the forming of consolidation pattern, or if the Fed was really hawkish, this would have some sort of a blow off top before then starting to roll over. Now, I'm in the camp that the yields start to slow down a little bit, just due to the fact that you are on a beautiful technical oversold move in yields, so overbought move in yields, and I do think some consolidation is needed to potentially make this a healthier move for yields to continue to move up. But if you look at something like this, where the bond market was getting hawkish, and then you had a blow off top, this was coinciding with a Fed meeting mid-month, you can see, and then obviously the market's got a little bit ahead of itself and it started to cool off. We could potentially see something like that again, where you have a blow off and then a big consolidation pattern. If we take a look at gold, gold was under pressure, and the interesting thing is that the miners were all negative to start the day. Gold still has an hour and 44 minutes, and it's come back from the negative side. It is trading positive, looking to close above the previous Friday trading session closing high. So that'll be short-term bullish if it can hold those levels and close above that. So that's just going to be interesting to watch, and just to see how gold closes in an hour and 44 minutes. I still think, based off of the underlying strength in like the GDX, the fact that miners are now put in this beautiful double bottom pattern, this W pattern, and the fact that miners are leading the actual physical metals, that's typically how the majority of the bull markets are, is when the miners start to lead the actual metals, the physical metal itself. And it's beautiful that, again, the miners were negative and they rallied to close above Friday's high trading session. So that is beautiful short-term price action. I'm loving this beautiful, almost an inverse head and shoulders pattern. You can argue that Newmont has this beautiful short-term breakout that is very, very close to happening. Obviously an upside target, just a quick little bit of a measurement using the technicals. If this were to break out, you have a move basically to this gap fill around this $50.70 level, and that would be your first major level of resistance. But clearly a beautiful potential, double-digit gain that is in the near term likely to happen based off of the price action in metals and gold. If we take a look at silver, once again, beautiful price action in silver. Beautiful tight consolidation. This type of pattern in silver is forming to be an explosive move to the upside. We could see, a massive silver day in and around the move of like 5-6% in one day. Silver can certainly start flying once it starts catching that bullish momentum and trend. And due to the fact that we're at such a critical level, if we simply go to the long term, the fact that you have this beautiful W weekly bottom forming, you're into these massive accumulation zones, your pre-COVID highs, even taking out the pre-COVID highs. So just clearly massive levels of technical support. And this is still a beautiful long-term bull flag pattern that if we can catch some sort of momentum, and break out of this short-term trend, it's very likely that we could see a rally all the way up to this 24 level. and then we'll have to reassess at that point in time. But silver can really start to move if it starts to catch that momentum trade as traders start to chase higher. Overall, oil, impressive price action in oil. This might be that, again, people are front running the United States government, since the United States government announced that they would start accumulating oil at 80. Well, they've now pretty much kiboshed that and put a stop to that statement, just due to the fact that oil has popped before it came into their level. I'm still in the camp that if we get a retrace up to this 90 or the top of this channel, I may look to a short. Oil's still notoriously weak. Yes, you're catching a little bit of a bounce here, but it is probably coinciding just with a little bit of a down move in the US dollar. Natural gas, interesting price action on natural gas. We actually still covered our KOLD, sold it on, I believe it was Thursday or Friday, for a beautiful profit. And look, we're back into that level, and so many people were jumping the gun on this head and shoulders, this potential topping formation. And it's only a potential, but not anymore. You've officially negated the head and shoulders formation on natural gas, which means that it is likely to go higher. So, since we've now closed back above the neckline, this pattern is now negated. You do not have a downside target. It is likely that natural gas is willing to float up, which is amazing because I would love to short natural gas again. And the interesting thing is that there were so many traders jumping the bandwagon, and still probably jumping the bandwagon, thinking that natural gas is a clear, easy, technical, highly probable short. And just due to the fact that this little nuance you've closed right above or on the neckline negates this topping formation in the short term before you can start to build yet again some sort of another pattern. So don't jump the gunner on inverse head and shoulders. Head and shoulders, it's very difficult to front run. Often the markets will love to lure, retail traders who don't have much experience in reading the charts, and they rope them in. I mean, the fact that you were down on natural gas almost 6% from this neckline, it was really making it seem that it was a confident, easy slam dunk trade. The fact that this topping pattern triggered, but nonetheless, the markets are going to do what the markets are going to do, and they trapped a whole bunch of investors with this beautiful reversal to negate the head and shoulders formation. Let's take a look at the IWM. We haven't touched on the Russell much. Let me just remove all the drawings on the Russell. So the Russell is showing a bit of relative strength. You've actually had a bullish engulfing candle, and the beautiful thing is that if you follow the Russell trend line, connecting this pivot to this pivot, it only just hit major support over basically yet Friday and today. So the Russell has not triggered a topping formation yet, which makes a lot of sense, because the Russell is comprised of 2,000 of the smaller cap, medium cap stocks, and those stocks have been beaten down tremendously in comparison to the big caps like Microsoft and Apple. And I won't say Facebook because Facebook's been obliterated, but the smaller names have been beaten down to a pulp, which suggests they have a lot more room to bounce if the dollar continues to weaken and if the markets catch a little bit of an underlying bid. And clearly the relative strength is now in the small cap stocks, which is why we have accumulated a variety of the small cap stocks, because if the indice is telling us that there's relative strength in the small and medium caps, we're going to stay away from the big caps and likely accumulate the small and mids, just so that we have the wind at our back, or the wind at our sails, the momentum behind us. So that's just a little bit of an interconnected market analysis nuance, and I just do think it's important to note that the defensive sector like healthcare was weak today, real estate was weak today, energy was weak today. You had a bounce in financials, builders, the industrials, consumer staples was flat. And then you also have utilities with a small bounce, along with technology and the consumer discretionary in the Dow. So a small technical bounce from the harsh sell-off, but don't think these markets are out of the woodworks yet. I certainly think there's going to be a lot more downside in the coming months. Bitcoin chart is really interesting. Let's take a look at Bitcoin. So BTC USD, the reason why Bitcoin's chart is so intriguing is, once again, it looked like you were going to get technical confirmation of a breakdown before, before this rally and reversal happens. So it looks like in 3.5 hours, Bitcoin will negate the confirmed downside break, and that is short-term bullish for this asset. Now, I mean very, very short-term. There's still tons of resistance up ahead for Bitcoin, but it's probably going to have to wait to make its move for the Fed decision. And honestly, the fact that Bitcoin is now traded over here once, didn't confirm another time, didn't confirm another time, that's 3, 4, 5. This is the 6th time Bitcoin is trying to break down, and you have not been able to crush it. So the more time it's hammering on this level, and you can see it's slowly starting to dip lower on this break, lower on this break, you have to think that the break to the downside will be confirmed in the very, very near term. And that's kind of what's going to be what is really going to be catching a lot of people for surprise. I think a lot of people are assuming that this is the Bitcoin base, this is the Bitcoin level, but I do think that this level is going to continue to break to take us down to the 10 to 13,000 level, where we should see another nice multi-week bounce. So that being said, hope all this analysis helps. Please give this video a big like down below and stay tuned for more market action tomorrow. And congratulations on the couple trades that we netted today in the